Berkshire is doing very well. Of course, it has an impeccable business model and exemplary management teams throughout the entire organization, but they've been also rapidly buying back their stock because Buffett himself clearly understands how cheap the shares are today relative to their intrinsic value. And in 2019, I disclosed a simplified model and our expectations for the market cap on the right here in 2030 of 1.7 trillion. And some very intelligent people pushed back. They suggest that this level of growth is impossible, yet these 2030 figures here remain unchanged since our prediction in 2019. And I remain confident that the shares will reach that level and maybe even past that 2030 estimate. So in the simple table, we have the sum of three parts. The cash, it's just cash. They have a large marketable, the market value of the market investment portfolio. And we've removed here the deferred capital gain tax, even though it's a liability that for a number of reasons, they may never have to actually pay. And a multiple on the growing earnings from over 100 independent, wholly owned subsidiaries like Mid-America Energy, NetJets, and Burlington Northern. So as of last week, you can see the middle of the column where it says value today. There's 100 billion in cash, 250 billion in equity portfolio net of all tax, and the value of their operating business of 540 billion. So this suggests 900 billion in value today, which is a 30% upside to today's price, and it is growing, which is why Buffett is spending tens of billions each year buying back Berkshire stock. So we are very fortunate to own this inexpensive, growing, super high quality firm. But of course, that's not all. Again, we don't pay New York Stock Exchange prices for our shares. We pay less, and we pay less than all investors are paying to buy the same exact investment using our structured value method to purchase the stock. Since the inception of this fund, we've been strategically accumulating shares in Berkshire through the sale of puts that we use as a tool to get paid before someone puts their shares into our portfolio. So in Q2 of 2020, over 2 years ago, when during the pandemic, when Berkshire's price fell to a completely irrational level, we immediately sold puts and started picking up premium and committing to buy these shares for $170. We earned through this process a fair amount of premiums, about $500,000, and that's illustrated here in step one. But we also needed to account for the unique period that we were in at the start of the pandemic. So as the unprecedented stimulus began flowing directly into the bank accounts in the US, the markets began moving up very quickly as people deployed their new cash into equities. We recognized that there was very little chance that we would have access to these shares at these prices in 2022. Berkshire's price was going to basically be far higher than 170 when they expired. So in step two, we used most of our put premium to buy in the money calls with $170 strike. By using those premiums to purchase the calls, they ultimately cost us zero. We paid nothing. In fact, we had some excess premium. So we obtained the calls and cash for free. And in step three, you'll see that the calls recently expired this June. And we finally exercised our right to purchase the shares of Berkshire for $170 when the market price of the company was $300. So it's an extraordinary result. You should be very pleased. The actions we took in 2020 were free, and our first cash outflow was less than 2 months ago. We spent $170 a share for stock selling on the New York Stock Exchange for $300, and we have substantial upside from here.